People love dividend investing, or at least the idea of it, and there's a ton of videos on YouTube talking about buying stocks that pay you dividends sometimes every single month. But just before you go throwing all of your money into buying them, here's 5 things that I think you need to know before you get started, and it might just change your opinion about dividend investing altogether. And before you think all of these points are going to be negative, I think you're going to be a little bit surprised. So this might sound obvious to some of you, but the magic money tree doesn't exist, or at least not yet anyway. And the cash that gets paid to you as a dividend is coming directly out of the business. And that means that as the money leaves the business, its value decreases in total. And think of it like this. Imagine this bucket represents a dividend company, and inside of it is $100. And that's all of the company has. And every year they pay out $5 as a dividend. Now, once the company pays out that $5 dividend payment to the shareholders, what's left? Well, $95. So the company, that whole bucket, is worth $5 less than it was before. Now, the stock market is a little more complicated in terms of what it might value the business at any point, but generally speaking, the company's share price is going to fall in value once the dividend gets paid out to match the amount paid out as a dividend. So, for example, if a company's share price is $100 and it pays out a $1 dividend, then we would expect that on the date that the company goes ex-dividend, the share price will fall around $1. Now look out for that the next time you're buying a stock if you want to see that in action. And remember that in order to get paid your dividend, you need to be a shareholder according to the date of record. Anyway, you get the point, I hope, but it's really important to know that dividends aren't free, and a company has to ideally make a profit and then share that profit with you as a shareholder. But then that does mean that you now need to make a decision about what you're going to do with it, which we'll dive into a bit later in the video. For now though, let's talk about point number 2. So just before you go hating on dividend stocks or think that I'm trying to say that they aren't important, on the flip side, dividends are actually a really important part about the total returns of the stock market. So when we say total returns, we're saying capital growth plus dividends, and here's a chart that shows this really well from Hartford Funds research. If we look back at the US stock market, more specifically the S&P 500 from all the way back from 1960 up until around 2021, and we invested $10,000 and then just left it, this chart is showing us how our investments would have done. As you can see, the grey line shows us what would have happened if we don't count dividends and then just remove them from total returns. Then the big blue shaded area shows what happened when we get paid the dividends and actually reinvest them. Now, as you can see, dividends have played a huge role in the returns of the stock market, and getting them reinvested really helps compounding those returns. And we all know how important compounding is over that long term. If you'd managed to actually invest $10,000 back then and never touched it, or just added to it over the years, then do feel free to send me some, as you'll have almost $5 million in total. And let's be honest, you don't need that much. I'll just send you my PayPal link and help me fill my ISA up this year, yeah? Okay, this is quite a contentious point which you'll see get argued quite a lot about. So on one hand, you have investors saying that they don't like them because they force them into paying taxes. But then on the other hand, you have people who actually want the income and figure out ways to protect their investments from tax. So who's right in this argument? Well, let's just break this down. When a dividend gets paid, it's creating a taxable event, and all that means is that you're earning money in the form of a dividend. Therefore, you need to sort out taxes if they apply to you in whatever country you're in, and so on. If a company didn't do this and never paid out a dividend, then obviously there's nothing to worry about, and you only have to think about taxes when you sell a stock. And that's based on your own choosing, not when the company decides to pay out a dividend instead. However, and here's the big caveat, it depends on your own tax rules and what accounts you're using. And if we speak from a UK perspective, we not only have a dividend allowance each year, which is currently £2,000, but we also have our investing accounts like our stocks and shares ISA, where we can pay no tax at all on dividends. So this means that if we're smart about it, we won't pay any taxes on the dividends we receive if we did manage to keep it all in an ISA, for example. And if you do want to open up a stocks and shares ISA for free, I always keep the latest offers in the description below. There's cash and free shares up for grabs, so don't forget to make the most of yours before the new tax year. Now, other countries are going to be different, and I'm not a professional, so do please check out your own rules. And also just to note that the dividend allowance rules are changing in the UK over the next 2 years, reducing to £1,000 and then £500. So using an ISA will be more important than ever. And finally, another little note, nothing's ever straightforward when it comes to taxes. If you do buy US stocks and you live in the UK, we are charged a withholding tax, which is 15%. Now, you won't have to do anything about it as it's taken off before it gets to your account, but just be aware of that in case you are wondering where some of that missing money went. So I think dividend investors will like being reminded of this one, and it is true that those companies who pay a dividend have done really well over many years. Now, especially when we're talking about companies who've paid and then grown their dividends through the decades. Now, let's just break down this and explain this one, because a company's stock price doesn't just go up because it pays a dividend. Over the long term, we do need a company to be profitable and then show lots of growth as well. The reason that companies who've paid a dividend have done well is because in order to pay out a dividend sustainably, you have to make plenty of profits year in, year out, and you need to run a business really well. So think of it like this: when you have a really well-run business like Coca-Cola, a company that's paid a dividend for more than 50 years, it's able to do this because it makes a lot of profits, keeps its costs under control, and has an incredible power behind its brand, meaning that even in hard times, they tend to do pretty well. And when you compare Coca-Cola to a company that isn't yet making a profit and losing lots of money, you can see why dividend-paying companies might be a bit more attractive to investors, as Coca-Cola would be making real profits right now, whereas some of these fast-growing stocks are promising to change the world, but their profits may take years to arrive or never arrive at all. So there's always risk there. Let me just show you something pretty cool. Even some of the world's biggest and exciting companies do actually pay out a dividend, even though you might not think of them as a traditional dividend stock. For example, Apple, the world's most valuable company, pays out a dividend, whether you knew that or not. Now, it's not exactly the best in the world when it comes to looking at the yield, which is the percentage per share that they pay you per year. However, if you've held onto Apple stock for a long time, check this out and you'll see why they can be really powerful. So at the moment, Apple's dividend yield is 0.67%, which just means that based on the current share price, around $137, each year you'll get about 90 cents, and you'll get 4 payments of around 23 cents or so as it currently stands. Now that doesn't sound impressive at all. However, check this out. If you'd held Apple stock for a long time, this dividend yield actually becomes a lot higher. So if we go back to 2012, when Apple had actually started to pay a dividend, and you invested in the company because you wanted a part of that as well as the growth, your dividend yield today would actually be around 4%. And that's because the share price you'd paid has gone up in value so much. And it doesn't stop there. If you've been investing for a super long time and happen to have some really old stock from, say, the early 2000s, your dividend yield would be around 350%, meaning that for every share you own, you're getting back more than 3 times every single year in dividends alone. Now that is some serious return, even if the company doesn't even grow anymore. Competition in the comment section below to see if we can find the Apple shareholders that goes back to the early 2000s. Let me know. Okay, final point, but one that's probably the most important and one that beginners fall into pretty easily if they start investing for dividends. Now this one's known as the dividend trap, and it's when you focus on the dividend yield and get enticed by seeing some really high numbers. You can see that there's loads of companies out there who maybe all of a sudden become really cheap, so their dividend yield shoots up. Now it's pretty simple math, right? If a company's worth $100 and pays out $5 for a dividend, that's a 5% dividend yield. If the stock then becomes worth $50 per share, on paper, the yield now says 10% rather than 5%. Now that starts to look really attractive. 10% return on a company through just a dividend gets your cogs going in your head. You're going to be rich and you can get 10% return every year from a pretty safe company. You've got to be laughing. But then you have to ask yourself the big question, is that dividend sustainable? For some perspective, some of the best dividend yields in the market from some of the best companies yield around 4% if you're doing really well. That's companies like 3M and Coca-Cola spring to mind to prove that point. But once you start looking at some really high ones in the double digits, the usual saying should be ringing alarm bells in your head. If it's too good to be true, then it usually is. I don't think the market is that stupid, even if it can be pretty dumb some of the time. And here's an interesting bit of research again from Hartford Funds, showing us that actually dividend stocks that perform the best in the long run in total returns are actually not the ones with the highest dividend yields, as you can see on screen here. So it's not the top 20% that perform the best in terms of yields. It was actually the second quintile, meaning that the stocks that fell between the top 21% to 40% had better long-term performance beating the overall stock market than the ones who had a high payout yield. So just remember this, think about the long term if that's what you're interested in, and always think if it's too good to be true, it almost certainly will be, especially when it comes to investing, because nothing is certain in this world. Anyway, I hope you found that video useful. Please share any more tips you might have for beginners below for dividend investing, and I will see you in the next video. Happy investing.